जनगण मन अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड उत्कल गंगा विंध्य हिमाचल यमुना गंगा उच्छल जलधि तरंगा तव शुभ नामे जागे तव शुभ आशीष मागे गाहे तव जय गाथा जनगण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे
रसिक हो नमस्कार. सहर्ष सादर करीत आहोत ज्ञानसाधना गीत. कवी प्राध्यापक प्रवीण दवणे, संगीत विनय राजवाडे.
शिवाचे मंदिर सुंदर मानव्याचा ध्यास निरंतर सत्य शिवाचे मंदिर सुंदर मानव्याचा ध्यास निरंतर गुरु शिष्याच्या नात्यामधली प्रतस्थ मन साधना सदैव उजळो आपुली ज्ञान साधना ज्ञान साधना. अज्ञानाचा तमः सारुण विश्वात्मक स्वर येई उजळून अज्ञानाचा तमः सारुण विश्वात्मक स्वर येई उजळून शूरवीर संतांचे पूजन जागविते चेतना ज्ञान ज्योतीने
As John Bogle smartly quoted, "Don't look for the needle in the haystack, just buy that haystack." Good morning, one and all. This is Ms. Barjay, student of Satish Pradhan Dnyanasadhana College. Welcome you all to the fourth day of our investment week. The stock market is a device for transforming money from impatient to patient. Introducing you all to our guest speaker for today's session, who will be teaching us about stock market investing and how beginners should deal with investing in stock market without being impatient. Mr. Sharad Pachisiya, CEO, Stage 1 Investment Advisor. He brings over 14 years of rich experience and expertise in Indian equity capital market. In his last role as Head Equity Sales and Senior Vice President in Edelweiss, Mr. Sharad Pachisiya played a vital role in building and scaling up the professional investors' equity desk practices. He has worked with Edelweiss Financial Services for over 12 years, with over 4 years in investment banking and over 8 years in private wealth management. He was also a part of senior leadership group of Edelweiss Financial Services. Mr. Sharad Pachisiya is also a guest lecturer at several colleges in Mumbai. So with that, we came to know that this session is going to be really good with explanations and understanding. So before any further ado, I would like to call upon our guest speaker for today's session, Mr. Sharad Pachisiya. Over to you, sir. Thank you.
Hello, everyone. Am I audible? Okay, sorry. Let me. Yes, thank you. Thank you so much for the kind introduction. Hi, guys. This is Sharad Pachisiya. I am currently working with Stage 1 Investment Advisors in the capacity as a CEO. This is an organization which was joined by me about a year back. So as Sage One, we are one of the leading investment managers in the country today, and we manage clients' money through PMSs and through AIFs. These are basically structures. The way you have mutual fund as a structure in the industry, you also have PMSs and AIFs. I'm glad and happy to be part of this forum, and good to be in front of you guys. As mentioned by the lady, that this session is all about equity investing and giving you guys some perspective of how this asset class works. And my endeavor for this next 1 hour would be to at least leave something behind, which can be a knowledge driven exercise for you and help you in your asset allocation and investing career. So let me just start the presentation. To begin with, I just thought, to give a sense of what investing actually means. I'm sure all of you would be aware, but just to set the context right, investing in a very simple, framework or language is the act of putting one's saving. So whatever you earn and then you spend, you're left with savings, putting that into a productive use with the objective or the expectation of making some returns, on that particular saving, which is more than inflation. And the reason inflation is important because that is nothing but the incremental cost of living. So you would want the money which you have saved and you've invested should actually give you returns which is more than the inflation rate. And this investment typically is put into assets. And assets is something which can be physical, the likes of gold or real estate, or they can be financial assets, which is stock markets. And as I mentioned at the start, that it's inflation which is important, and that's nothing but the rate of increase of cost of living. So standing today, our inflation would be close to 5%. So if I invest today 100 rupees, I would like to at least grow that 100 rupees more than 105, because my 5 rupees is actually the incremental cost of living for me for next 1 year. To give you guys some sense of what kind of asset classes are available in the markets for investors and what kind of returns they have generated in the last 5, 10, 15, 20 years, I have just presented a small table, if you can see. These are basically the post-tax returns, or you can call the annualized returns of various asset classes. It's very important to know post-tax, because it's not that whatever you earn is something which you have at hand, right? You have to pay taxes. So every asset class has a different taxation rate. So it's the net returns, which is net of tax, which is important. And that should be ideally over and above the inflation rate, right? So if you see, it is, you have obviously today options to invest is bank fixed deposit. By the way, India as a country, still till date, is largest saving goes into bank FDs and it goes into gold. India's population hardly invests in equities. Less than 2% of the population actually till date also invests in equities. And the reason could be either they don't have understanding, or they don't have awareness, or maybe they don't want to put money in equities because of the risk factors which come into play. But certainly the trend is changing. The millennial population, which is people like you, have taken equities as a route for investing their savings, and the reasons are plentyfold. I'll explain you exactly in later part of the presentation why equities makes the most sense today. So just give you numbers. Even real estate, which is I've mentioned as property, is another option. So largely there are 4 options, which is equities, gold, bank fixed deposits, and the properties. If you look at the columns, let us look at probably ideally the 10-year period as a return. Just see the 10-year period return for equities has been 17% in the last 10 years. Equities have given return of 17% per annum, which definitely is above the inflation rates, right? Inflation in the past used to be hovering at say 8-9%, which today is about 5%. In spite of that, the returns on equities are 17%, and these are by far the maximum among asset classes. See gold, which has given you almost 13% for the same period. Bank FDs actually, to me, looks to be more of a criminal asset class to invest in. If you invest in banks which give you 5%, which is barely meeting the inflation rate, practically you're not growing your money even more than the inflation rate. Though bank deposits look to be very safer, but they don't come with good returns. So I, as a particular individual, generally don't invest a single penny in FDs, because I at least want my money to grow more than inflation. Property, which is real estate, in the past has given 13% returns. Now if you look at the idea of this slide, or the overall objective is to make you understand, guys, that investing is not about short term. Investing is about long term, and for me, long term is minimum 5 years. It is not 1 year. You have to have a vision of investing your savings for a larger period, and that is the probably way you would able to grow your money and be patient. That's the idea that, as I mentioned, it has been the performance outlier. Equities has been the performance outlier, and the reason are equities as an asset class has been able to grow much more than other asset classes. Now, how would you define equities? What exactly is equities? So, in plain simple language, equity is what? It is nothing but ownership, right? I mean, you own a stock. When you say I own a stock, you're doing nothing but you're owning shares of a company, and you are partly an owner of the company. Every company has its share capital, right? So when you are buying into the company, you're buying the stock of the company from markets, you are nothing but an equity holder, and you are one of the owners of the company. Now, equity investments as an asset class are supposed to give you returns, right? And the returns are but the larger portion of returns is through capital appreciation. The endeavor or the objective is today, if I invest it at 100 rupees, I would want at least that 100 to become say 115 or 120, over the next 3 to 5 years. That is the larger return expectation from equity, that dividend plus capital appreciation. That capital appreciation, nothing but the stock price appreciation. Equity as an asset class is the most liquid, compared to even a gold or real estate. It is very, very liquid. Today you buy something, tomorrow you need money for any urgent purpose, you can simply sell the shares or mutual funds, and your money is returned back to you within 2 days. Compare this to gold, which could take time, which definitely could take time more than 2 days, and real estate for sure. There have been times where real estate doesn't get sold for years. So liquidity is very, very important factor for judging a particular asset, and equity brings that highest liquidity. Yeah, but they don't come with assured returns. There's nothing called assured returns, right, in equities. It is only bank FDs which say, okay, I give you 5% return or 6% returns. Neither gold, neither real estate, neither equities, they don't come with any assured returns. That needs to be very well kept in mind by all the investors. And it is a game where you need to understand the risk profile of asset classes you're entering into, and you have to see how you are as a person. It's not a formula that a particular person should invest this much in equities, this much in gold, or this much in real estate. I say it all depends on the risk appetite of the person, how much willing that person is to take the risk. And it goes well that higher the risk, definitely higher the returns in equity asset classes. But if your horizon is long term, if you don't really need money for the next 5-7 years, certainly equities as an asset class is definitely better off than other asset classes. And I'm sure you guys look at markets, that it's not linear, right? The growth is absolutely not linear. You will make money at the rate of 15% per annum for the next 5 years, but within that period you will see probably markets going from 100 to 80, then 80 to 120, then 120 to 100, and finally say 150. So then 100 becomes 150 at the end of 4 years. That is nothing but a return of 15% per annum. But it is not that every year you will end up making 15%. So equity is definitely volatile, and that has to be definitely kept in mind. Equities is not an easy asset class. It looks to be easy, it looks to be as if I have to just buy something and sell tomorrow, or I have to buy something and sell after 5 years, and it's pretty easy as an opportunity, but it's not. And through my years of experience for the last 14 years, I personally believe even after being there for 14 years, I still don't know a lot about equities. It's an ever learning exercise for me, and it needs a lot of discipline. It needs a lot of monitoring, because end of the day you are investing in companies. So understanding of the companies, the businesses, the fundamentals of the companies are very, very important. A lot of people take the shorter route. They try to speculate, and they actually at times get lucky. Especially in bull markets, everyone will have an idea or two. Even a pawn shop guy will have an idea to talk about, and that is where the problem arises. You will make money or 2 on 3 stocks, and you believe, oh, I know equities, I've made money. And then the 4th or 5th stocks, you'll come and you'll go all in with your money you've made. And that is where the trap is. You end up with all the junk stocks, and then they never recover to the cost price of yours. So it's a completely advice to stay out of speculation. Speculation is not the right way to invest. Investing to me is long term. Yes, there is a segment of investors who do trade in equities, but that is also a professional approach. They have studied the various technical analysis on how to identify a stock through the price trend, and it's a complete different professional course, which professionals do it, and they then resort to equity trading. But for beginners, for novice people, I would really advise not to get into trading. You don't confuse luck with brains. You can be lucky 8 out of 10 times also, but the 2 times you're not lucky, you might end up wasting or destroying all your wealth, whatever you've created. Plus at the same time, you might have to pay more from your pocket. So as I mentioned, it needs skill sets to identify stocks. It's a complete different field. It's a science behind it. There's a science and art behind equity investing. There are people who have gone through a lot of fundamental analysis courses, and there are a lot of courses available in the market. So depending on your interest, one can look at probably making a career in equities. Then going through that professional training is very, very important. Mind you guys, there are 5,000 companies listed in markets today. And that's a huge number, right? India as a country has by far the maximum number of companies listed. And you know, every year you hear about IPOs, right? So what is an IPO? IPO is nothing but a new company getting listed on markets. And markets are typically what? Today we hear markets, it's nothing but the exchange. So in India, we have two exchanges. One is NSE, which is National Stock Exchange, and the other is BSE, which is Bombay Stock Exchange. And these are the exchanges where equities get listed. So any new IPO you will see them getting listed in these two bourses. In global parlance, you call them as bourses, stock exchange or bourses. And India, as I mentioned, has 5,000 companies listed. So it needs lot of in-depth understanding, analysis of companies. It's practically not possible to go through 5,000 companies, right? So one needs to be very, very, clear that what he needs to look into equities to identify stocks. And typically, if you end up owning 20 stocks, that's more than enough. So, beyond 20 stocks, ideally, it's not the right way of investing. And that I'm talking if someone is doing direct investing. There are definitely, ways to invest in equities. Someone who and if he or she doesn't understand equities, doesn't really understand the fundamentals and the technical part of equities, then it's better to route your savings through mutual funds or PMSs, which I'll talk later. This pretty much sums, how you would probably start investing into stocks. So as I mentioned, one way is direct investing. When I say direct, it is you as an individual, who is taking call on what to invest. So you would open your account with a broker, and there are a lot of brokers on the street today. You have, the larger names like HDFC Securities, which is owned by HDFC Bank, ICICI Securities, which is owned by ICICI Bank. Zerodha, I'm sure you've heard about. That's a new age fintech broker. Grow is another fintech broker. So a lot of these, broking platforms are available where you need to open your Demat and trading account. So Demat account is nothing like a bank account. The way you have money kept in your bank account, it's the same way you keep your stocks in the Demat accounts. But when you have to buy or sell that stock, then you have to have a trading account for that. So that is why the brokers open the Demat and trading account of the client. And when you need to buy the stock, you buy the stock, pay money upfront for the money you bought, and you get your stocks in your Demat account. And if you sell the stocks, you sell the stocks first, and then the money comes to you within 2 days on your in the trading account and the bank account part of it. This is one way, and I'm assuring you guys, I'm not saying that this is the only way. Honestly, it's the toughest way because it needs you to have understanding of the companies investing and not go through the speculative way, not go by conviction of other players or tips, as we rightly call people. I'm sure you hear about tips, then which are the good stocks to buy into. I would certainly discourage people to, venture that way and that route. If at all you have understanding, if at all you are really, really serious and curious to start this on your own, first go through the pain and learnings and the, exercise of how to do it, which I'm sure, a few of you would in your, careers ahead. But, just don't start direct investing because you want to start into equities. The ideal way to start equities would be start through mutual funds. And these are nothing but organizations, the mutual funds, PMSs. These are organizations where there are professionals. There are professionals who have gone through that years of experience, who have understood market cycles, who understand what to buy, what to hold, who understand what not to buy. That's very, very important. And they are the ones who manage basically the money which is given to investors. And you can start as low as 500 rupees. I mean, that's the beauty of mutual funds. Mutual funds, except 500 rupees, there are various schemes, there are various mutual funds in the market. Which one to choose also is very, very important. And there are various sites. There's a site called equitymaster.com, mutualfundsahiha.com, and these are the websites which basically have which list the mutual fund schemes and their past returns. Ideally, the way you should select a mutual fund, you should look at the years of existence of that particular mutual fund. You should go a bit on the fund manager, who's the fund manager, what kind of experience that fund manager carries, and decide on the scheme which you want to invest into. It could be a large cap scheme, it could be a mid cap scheme, it could be a small cap scheme. Just for the benefit of all, what are these large cap, mid cap, and small caps? These are nothing but the bifurcation done of stocks. So when I say there are 5,000 stocks listed in markets, there are few stocks which will be classified as large caps. There'll be few which will be classified as mid caps, and there'll be few which will be classified as small caps. Large caps are typically companies which are at least with a market capitalization, and this concept of market capitalization is what I'm going to also share with you guys in the later slide. At least the market capitalization is more than 30,000 crores. So companies which have a value of more than 30,000 crores are typically classified as large caps. And in India, there would be not more than 100 companies with that kind of market capitalization. So the top 100 companies are typically classified as large caps. The 101st company, which is 101th company to say 250th company, the next 150 will be classified as mid caps. Here, the value of the companies would be between say 8,000 crores to 30,000 crores, and these are mid cap companies. And then anything below 8,000 crores are qualified as small caps. So mutual fund also have schemes where they say, hey, if you're looking at investing into large caps only, I have a large cap scheme. If you want to look at investing only in the mid cap stocks, then I have a mid cap scheme. And if you're looking at only investing in small caps, then I have a small cap. There are few schemes which say I can do multi caps. So I will also buy a large cap, some large cap, I will buy some mid cap, I'll buy some small cap. So there is something called multi cap schemes also. Ideally, and again, just because a company is qualified as large cap doesn't mean that it's the safest of the companies, but certainly large caps are the companies which have years of existence in markets. They have proven, they have a proven management, and certainly the businesses are larger. So just to give you example, today a Reliance Industries or an HDFC Bank or a Maruti, these are large caps because their market caps are more than 30,000 crores. They have been in markets for more than 20, 25, 30 years. They have proven their business strength, and therefore they are qualified as large caps. If someone is looking to invest in such quality businesses only, then just go for large caps. But certainly large caps will not give you returns of 20% plus typically. I mean, this year was a very, very abnormal year. This was a exception year where large caps have given you more than 60% returns in 1 year. But typically the expectations of large cap investing should be not more than 10 to 12% per annum. It's safe, it's stable, but you will not make more than 12 or 13% returns in this particular category. If someone wants to make more money, if someone wants to grow their money faster and more than large caps, then that's where mid and small caps come into play. And these are again good companies, but certainly they are more volatile than large caps because the base is smaller. They are smaller companies. But yes, if the fund manager is good, if he or she is able to identify stocks, mid and small caps eventually give better returns. And if someone has a 5-year view, I certainly believe in the next 5 years, it is mid and small caps which can do much better returns. But one has to be patient. One has to absorb the volatility. One should be not having fear that when these mid caps come down 20%, they really have the fear. That should not be the case. You need to be invested for the next 5 years. And mutual funds, the best part is you can invest either at one go. If you have lump sum with you, you can invest at one go. Or you can do SIPs, which is what I mentioned in the slide, which is nothing but systematic investment plan. So you can decide that, hey, I every month would need to deploy 2,000 rupees, and you can get into a mutual fund, say I want to go SIP way, and every month end or whatever dates you want to decide, that money gets debited from your bank account and goes into the mutual funds. So you basically get the mutual fund units allotted every month in your Demat account. So SIPs are also really good. That allows you to basically not time the market, and everyone tries to time the market. They say jab niche aayega tab lunga, upar jayega tab bech dunga. Aisa nahi hota hai. You have to only stick to investing and have a discipline. Trying to time the market is very futile. Even we as managers and fund managers, we can't time the market. It's a very, very difficult task. It is only luck that markets have gone down, and if you invested, that's good luck for you. So SIP that way is discipline, because every month your money will go out, and there will be times that you'll buy at higher prices, and there'll be times you'll buy at lower prices. So in that way, it averages out. So SIP is ideally I would an investment for young generation like you. The second option, PMSs, this again is another way of investing in markets, but this typically is available for high net worth individuals. The structure exactly is like fund managers who invest clients' money who are professionals, but the minimum ticket size of this is 50 lakhs to start with. So typically it's the high net worth individuals who invest in PMSs, and they refrain from investing in mutual funds because PMSs give them much more flexibility. They can buy only 10 stocks, and they can, have very high concentration. So 10 stocks they will buy 10% of each stock, compared to a mutual fund which will have 60, 70 stocks in a scheme. Those mutual funds are a bit more diversified. But PMSs, as I mentioned, is largely for the high net worth individuals. These are largely for your concept, just to understand what exactly is a PMS, and nothing much to delve deeper into it. Now, this is, I would say, a very crucial slide. This is for the audience who are a bit curious about equities and who probably would want to, pursue equities as a career. Maybe, work in companies where these companies are responsible for managing money, the likes of PMSs or mutual funds. And if you want to work, then you obviously need to be familiar with the concepts. You need to go through the, professional courses. But for this session, I just thought, let me point out to you a few things which are basic and should be good for your knowledge, because you keep reading newspapers and you will come across these terms. So I'm sure most of you guys are aware of it, but my only submission was to give you guys my perspective. So as I mentioned, there are two stock exchanges, NSE and BSE. These are the exchanges where the companies are listed. Now, every exchange has its indices. It has a benchmark index. And when we talk about markets, what we speak, we say Sensex, we say Nifty. So what is Nifty? Nifty is nothing but the index of NSE. And this is a index of 50 stocks. 50 stocks of India out of 5,000 companies are representative of this index. And these would include typically the large caps. So the Reliance Industries, the HDFC Bank, the Marutis of the world, the ICICI banks, typically they are part of the Nifty. And you hear the concept of Nifty 50. That is the index which is part of the NSE. And the similar index for BSE is Sensex. Sensex is nothing but 30 stock portfolio, 30 stock index. So it would have all the stocks of Nifty, and Nifty would have more stocks than obviously Sensex. These are two large cap indices in the markets. The way you have large cap indices, the same way you have even mid and small cap indices of particular exchanges. So a Nifty mid cap 100 or a Nifty small cap 100 is the indices available for small and mid caps as part of NSE. So if you go to NSE website and if you see the products and offerings, you will see these indices. And these are nothing but representative of the respective market caps. So as I mentioned, there are large caps, mid caps, small caps. It's the same way if you are investing in large cap PMS or a large cap mutual fund, the typical benchmarking that, how much your fund has done well compared to a benchmark, it should be the relevant benchmark. So if it is a large cap mutual fund, then you should see, okay, fine, my mutual fund has given return of say 12% per annum. If Nifty 50 as an index has given return of more than 12%, your mutual fund has underperformed because you have grown lesser than the large cap index, which is Nifty 50. But if your mutual fund's performance is more than the Nifty 50 indices, then your fund has outperformed. Mutual funds large cap historically have given returns of more than 14 to 15% per annum, which is in line to what Nifty 50 has also given in the last 10 to 15 years. So assuming a 14 to 15% return per annum from a large cap is okay, but I think going forward, I don't think, markets also evolving, they become far more tougher. I would be happy if I'm ending up making 10 to 12% returns now from markets from this large cap schemes, because I think now 14-15% returns from large caps on a consistent basis per annum looks difficult. Economies are evolving. There are so many disruptions. Businesses which used to survive for 20 years in the past are not surviving for 5 years. And large cap businesses also. Mind you, Yes Bank, you all know, it was a large cap company. But the debacle of Yes Bank, it's no more there in the picture, right? The fraud which happened in Yes Bank. So there are businesses which may not survive only after 5 years. So that makes a lot more difficult for you to grow your investments of more than 10 to 12% per annum in large caps. Yes, there's a possibility of making more money in mid and small caps. But as I told you guys, that comes with volatility. There is a high risk factor. And if you think you are a person who can take risk, then certainly more portion of your money can be in mid and small caps compared to large caps. Every index has, as I told you, representative companies of the particular sectors. So if you see Nifty 50, you will see companies from auto industries, companies from banks, companies from cement, companies from IT, pharma. So it is nothing but a combination of sectors and representative of sectors of the economy of India. And it's a good indicator. When Nifty is doing well, certainly the belief is that the economy is doing well. However, I believe markets and economy have two different there are two different aspects. Certainly markets reflect what is happening in the economy, but that is not real time basis. So you can't just say that today markets are going up, that means economy is going up. That's not the case. Typically markets are forward looking. Market have the ability to predict. They assume, or they have the ability to gauge what's going to happen in future. And that is the reason, I'm sure everyone would be confused and surprised that in COVID times, when actually COVID hit India in March 2020, and obviously economy crashed, the economy was completely shut down across the world. And obviously markets reacted, and in the 1 month of March itself, Nifty 50, which is the large cap index, went down by 25%. It has never ever happened. In the past, very few times Nifty has gone down 25%, and that too so fast. But what happened post that? Post that, COVID cases kept on rising, right? Economy kept on not opening up, but markets completely rebounded from June, and now you are hitting life highs where economy is still not come back to normal. So that is what I'm trying to say, that markets have the ability to predict. So market may be saying that COVID is past, and now market is saying what will happen in 2021 or what is happening on 2022, and that is they're trying to reflect in stock prices today. So don't get confused, or don't get shocked that economy is not at the best of the shape, but markets are doing well. That is how the markets behave. They are forward looking, but at the same time, predicting markets or how markets will pan out is very difficult. I mean, we have market commentators who give up a target, or who say, this is going to happen in 1 year, this is going to happen 6 months. I typically don't pay too much of attention to them. I think they are largely to keep the attention of the viewers. But equity investing is very difficult as an exercise to predict. As I mentioned, it's very, very difficult. Even for professionals like us, we really don't predict the market move. What we really focus on is understanding businesses. Every company is different. A banking company is different from a pharma company. A cement company is different from IT companies. What is going into the business? How are the companies doing fundamentally? That is very, very important. Now, the concept of market capitalization. Now, as I mentioned, that what is market capitalization? This is nothing but the worth of a company. What is the value of the company? What market is giving a value to a company? So, as I mentioned, a company has shares outstanding. So a company issues shares, and there's a price per share, right? What you see in the stock prices of a particular company in the exchanges. So every day there's a price, right? If you multiply the price into the total shares outstanding of the company, you get a number which is value. This is nothing but the market capitalization. So the total market capitalization, the total worth of all the Indian companies listed, okay, which is, as I said, 5,000 plus companies listed in market, is close to $2.3 trillion. $2.3 trillion. What is our economy? What is our economy GDP? Our economy GDP is close to 2.3, $2.4 trillion. So GDP of the country is $2.3 trillion today, and the market capitalization of all the listed companies in India is today $2.3 trillion. Just see the number now. Compare India's market cap or India's total market capitalization to global market capitalization of listed companies. Global, which is all the countries put together, the market capitalization of listed companies is $100 trillion. So we are $2.3 trillion out of 100. So we are not even less than 2.5%. Yeah, we are 2.3% of the total market capitalization of listed companies across the globe. Again, to give you some context, we are $2.3 trillion. You know what is US as an economy? The US market capitalization of all the listed companies put together is $40 trillion. So US is 40% of the global market capitalization. So we are nowhere, right? We are less than 2.5%. And that is an opportunity. That is where I believe, so the way Indian economy is, the way you have new age companies, the way the demographics of this country, the young population, I think we have long way to go. We have long way to go. It's just about how one is able to, understand which are the sectors which will do well for the next 5 years, or which are the companies within those sectors who will be leaders, right? Every company of a sector is not the leader, right? You just have one Maruti, and there are so many auto companies in India, in the country today. There is Maruti, there is Tata Motors, there is Ashok Leyland, there is Aisha Motors. There are good 15, 20 odd companies probably in auto space, but you just have one leader. You have Maruti, right? Maruti, by the way, is 47% market share of the auto. So every 100 cars which are sold, 47 cars are actually of Maruti, which is a very big number. So ability to understand which sectors will do well for the next 5 years, within those sectors, which are the companies which are really good, which are better than the competition, which will probably grow more than the competition and become leaders tomorrow, is very, very important. And that is what the role we as professional managers do. We keep on studying sectors, we keep on studying companies, and try to understand which are the companies of particular sector which will do well. And then we try to buy them at a right price, because buying at a right price is also very important. Just because something is really good doesn't mean that it is a great investment. You could have a great company, like, say, for example, a Kotak Bank. It is a great company, it's a great business, but is it a great price to enter today? Because eventually you are investing for making money, right? So that is very, very important. Every company, irrespective of whether it's a great company, doesn't mean that every time it's the right price to buy. And that is where the analysis, the fundamental analysis comes into play. How would you understand a particular business, the profitability of the business, and then try to understand that is it worth buying today at the price at which is trading, or we should wait? And it's tough, by the way, guys. It's not easy. It needs years of experience and understanding to really gauge that part. Even as we speak, I mean, even we try to understand or learn every day. To talk about which are the top 3 companies by market capitalization in India, I'm sure you guys are aware, but just to give you numbers, Reliance Industries is the largest company today by market capitalization. The market capitalization is close to $175 billion. In terms of Indian numbers, this would be close to, let's say, 14 lakh crores. 14 lakh crores, yes. The second company is TCS, Tata Consultancy Services. It's an IT company. Here the market capitalization is $160 billion. And the third company is HDFC Bank. Here the market capitalization is $110 billion, which is close to 7.5 lakh crores. Okay. HDFC Bank is the largest bank in India by market capitalization with 7.5 lakh crores. Now understand this. Now let me give you a size perspective. The highest company by market capitalization, the highest bank basically globally by market capitalization, is not less than $500 billion, 5 times of HDFC. And maybe I think it's close to $1 trillion of market capitalization. That's the difference between an Indian bank, which is largest by market cap, compared to a bank which is the largest by market cap globally. Again, just to give you numbers, Apple is obviously US based company. They make the iPhones. What is the market capitalization of Apple today? Apple's market capitalization, only worth of Apple, is $2.1 trillion. Imagine. That is the value of Apple itself. This is close to the entire market capitalization of listed companies in India, right? Because the entire listed company's market capitalization today is $2.3 trillion. And Apple itself is only $2.1 trillion. So Apple put together, Apple is basically collective value of all the listed companies of India, which is massive, right? And that is the beauty of companies in US. I mean, they're able to gain market share globally. One company is worth the entire market capitalization of India today. The size is humongous, and that kind of gives a lot of comfort, assurance, or excitement that maybe India is where US was 15 years back. And if everything goes well, you could see 1 or 2 companies which will emerge far bigger, and they could be one of the largest companies globally. So this is the beauty of investing in equities. See the kind of size and the kind of scale companies can go through. And it only is possible in equity investing, right? Because there's nothing called a fixed return in equities, but at the same time, there's no cap in terms of returns. There are times where you make money more than 100% in 1 year. There are times where you make money 4x, 5x, 7x, 10x in 5 years, 7 years. If you have the right set of companies, you bought and you stayed put, you've not sold them when they've gone up by 20%, is when you kind of make these kind of money from. And a lot of clients, a lot of investors do make money. It is about understanding and about patience. That's very, very important. To give you guys some sense on company fundamentals, a few pointers maybe that you might be hearing, you might be reading in newspapers or your books. Earnings, that's the number, that's the first thing which comes into play. What is earnings? That is nothing but profitability of the company. So the profit after tax is nothing but the earnings of the company, which is what the company end of the day makes, right? If a company is selling something worth 100 rupees, if you reduce all the cost, the operating cost, the financial cost, and then you reduce the tax, and if you left with 20, that is what nothing but the profit or earnings of the company. Now, what is margins? This is nothing but a percentage of what you earn of sales. So as I mentioned, if 100 rupees is the sales of the company and you end up making profit of 20 rupees, what is the margin? 20%. 20 rupees, which is earnings divided by sales. So margins are also very, very important. So earnings, which is nothing but PAT, profit after tax, and margins are typically profit after margins. There are also concepts of gross margins, EBITDA margins, and these are concepts which certainly you guys will you will hear or you will read down the line. But for the time being, it's important to just understand what margins are. Eventually, they are nothing but ratios. So whether you divide EBITDA upon sales, you get EBITDA margins. If you divide PAT upon sales, you get profit margins. And return ratios, I mean, these are very, very important. Again, the margins are also one of the return ratios, but typically return ratios are in the form of, say, for example, debt of a company upon total equity of a company. So you've heard about the, debt is what the company borrows from outside. Equity is its own capital, right? Debt is what it borrows from outside. So if you divide debt upon equity, you get debt equity ratio. That is one form of ratio. If a company has a capital of 100 rupees, 100 rupees is a capital, okay, and it has generated a profit of 30 rupees, then the ratio of profit upon the capital is nothing but return on capital. So these are the concepts which you should be familiar with. This 1 hour session is not something where I could delve deeper into every ratio, but certainly the concepts is something which I wanted to highlight to you guys, so that if you come across these words in your readings, you should not get confused. A very important website which I want to highlight you guys, you should definitely refer. And this is a brilliant website for understanding the financial concepts. In my early days, I used to read newspapers, I used to read Mint, I used to read Business Standard. I used to come across a lot of words which were not familiar, and my curiosity always led me to search online immediately. That, hey, what is this? And I came across this website called Investopedia. INVESTOPEDIA. Investopedia.com is the website which I am really I'm in love with, and I still keep referring it. I would really recommend you guys to refer this website for terms which you want to understand beyond obviously the books. So this is one website which I really recommend you guys to have it handy with you guys. Now, valuations. Again, I'm sure this is another word which you keep hearing, either in books or newspapers. Again, this is nothing but a ratio, by the way, guys. So the most common heard ratio is price earning multiple. What is that? It's nothing but the profit of a company, which is the earnings, and the price per share of a company. So if you divide the price per share of a company by the earnings per share. So when I told you about earnings, this was total profit of the company, right? If you want to find the earnings per share, what you do? You basically divide the profit of the company by the total shares outstanding of the company. Every company will have its share outstanding, right? Total number of shares. So that will give you what is the earning per share, right? So you get earning per share. Price per share is available in the markets. Every stock has a price per share. So when you see a Reliance Industries today at, say, for example, 2,000 rupees, that is nothing but price per share. So price per share, if you divide by the earnings per share, you get price earning multiple, which is called as a P ratio. There are data points, or there are writings that say you should not invest in higher P, multiple companies because they're expensive, or you should invest only in lower P stocks because they are cheap. I mean, these are not something which is practical aspects. That doesn't work. It is not necessary that a high P ratio company will not do better than the low P ratio company, or a low P ratio company will be doing better than the high P ratio company. Typically, it is as I told you have to go beyond the ratios. You have to understand the businesses. You have to understand the earnings of the company, how fast the earnings can grow in the next 3 to 5 years. Are the earnings more than the competition? And then probably arrive at a value and decide that at this value, even if the company is trading at a higher multiple, is it worth investing? There have been numerous cases in the past where a higher P multiple of a company has become all the more higher because the earnings growth was superior than the low P multiple companies. So don't go by that logic of low P means cheap, high P means expensive. You cannot just look at a multiple and say whether the stock is cheap or expensive. As I mentioned, there are a lot of things which goes into, and largely the fundamental aspects of the companies are very, very important to decide whether the company's value to buy today or not. Another ratio which is commonly used is price to book value multiple. Again, it is price per share upon book value per share. And book value per share, as you know, is nothing but the total capital of the company. Total capital of the company divided by the shares outstanding. So once you divide the capital of the company by shares outstanding, you get the book value multiple, book value shares per share. And if you divide the price per share upon book value per share, you basically get the book value multiple. Again, guys, this is not to confuse you. Again, just to keep in mind that, when someone talks to you about valuation, what does that mean? When someone talks to you about company fundamentals, what does that mean? It's a complete, exhaustive, comprehensive course, which is there in the markets in the form of financial management, portfolio management, or there are these courses like CFA, you must have heard. So these are the courses which help you understand more about these aspects. But for the timing, it's important to just be familiar with the concepts. This is very, very, very important, guys, and this is one aspect which I want you to keep in mind. Equity markets, as I told you, is not about quick gains. It is not about making money quick and short term. You have to be patient. It is the ability of this asset class where your earnings or your returns can compound. When I say compound, it is this asset class only where today if you invest 100 rupees and after 1 year it is 15% returns, and that becomes 115. Next year this 115 grows by 15%. It's not the only 100 rupees. So whatever you earned every year, that also grows. And that is the beauty of this asset class, that it keeps on compounding. That's where the concept of compounding comes into play. That equity as an asset class needs to be looked as a compounding asset class. It is not gold where it is only the price appreciation. It is the returns of the equity also which grows along with the principal every year. This is a small table which gives you a sense of the power of compounding. Maybe refer to the columns. The columns are nothing but the rate of return. So 4% per annum, 5% per annum to 20% per annum. This is the rate at which an equity is compounding. So 20% per annum. And the first column is period, which is years, right? So year 1, year 2 to year 20. Now see, if I have invested in equity with a return expectation of 10% per annum, okay? So I invest 1 rupee, end of 1 year, what will happen? It will grow at 10%, so 1 will become 1.1. Now, if I invest for 5 years, then this 1.1 becomes 1.61. So 1 has become 1.61 at the end of 5 years. That means it has compounded at the rate of 10% per annum, right, for 5 years. What if my horizon is 10 years? So if my horizon is 10 years, see guys, even if the return for 10 years is 8% per annum, but after 10 years, what will be the amount? It is 2.16. See, an asset has grown lesser than 10%, but it has grown for 10 years compared to 5 years when it was growing at 10%. So 8% per annum for 10 years gives you 2.16. So 1 becomes 2.16 at the end of 10 years, even if it is growing lesser than 10%, but it is growing for more years, right? It is growing for 10 years. Compare this to 10% returns you've earned, but only for 5 years, it is 1.61, which is much lesser than 2.16. So 1.61, 2.16. And that is the beauty, that if you stay longer, the longer you stay in terms of years in the equity asset class, even if you're earning lesser returns, which is 8, even if say, for example, 8% is what I gave you an example for 10 years, right? 2.16. Now say you are only earning 6%, but you're earning for next 15 years, okay? Or next say 20 years. 6% for next 20 years gives you 3.21% compared to 8% for 10 years gives you 2.16. So highlight of this particular slide is that invest for long term, invest for really long periods of time, at least 5 years, 10 years, 15 years, and have a return expectation of not more than say 12 to 14%. Even if it is 12 to 14% and it keeps growing every year, at the same rate, it is huge money, right? Say 12% per annum invested for the next 15 years makes your money 5x. So one has become 5 times, which is beautiful, which is more than you earn in gold today, or which you earn definitely much more than what you do in FD. So if you would have invested in FD for 10 years, that would not grow more than 4 or 5% net of tax. Compare this to equities, where it is a reasonable expectation that your equity investment should go at 12 to 14%. The higher you invest, the higher period, number of years you invest, the chances are that you will grow your money much more. So one should be very clear that equity investment to me is long term. Equity investment is not about short term. There are no shortcuts to equity investing. If someone is taking shortcuts, he or she is typically, giving a lot of importance to luck. You can be lucky a lot of times, but there are times where you will not be lucky. And I dread for those years when you're not lucky, because when I started my career, honestly, I also got into this habit of trading. I made money once, twice, but third time I lost all what I had, and I had to even pay more from my pocket. And that's when I realized that this is not my game. It is all about long-term investing. And then I honed my skills of how to look for companies, how to identify companies. And since then, it's been 7 years I've been investing, and completely long-term. I don't get disassociated. I don't get tempted to, get in and try to make quick buck, because I have experienced that it is a zero-sum game. I don't want to too much depend on luck. I can be lucky, but I don't want to go that path. As I mentioned, people do trade, but those typically are the ones who trade professionally, who have understood the science, who have done good courses, and then they are getting into trading. But still, that is not my area of expertise, and I refrain, or I discourage typically people to trade. It's better you start early. It's better you think long term. And to start, I would say mutual fund is a very good route for beginners and people who are curious or who would want to really start investing on their own. Certainly, you should start with large caps, because that is one space where the information about companies is a lot more. You can read about those companies, you can understand the fundamentals, and then maybe take a call of investing individually in these large caps. And then see, maybe, or you can do mix of both. You can have some portion of your savings directly put into stocks, and some portion of your savings put into mutual funds. Ideally, large caps is what you can do probably directly, because as I mentioned, the information is a lot more. You can read a lot more about HDFC Bank or a Maruti or a Reliance Industries or a TCS, Infosys, that you can invest on your own if you're interested. And the mid and small cap segment, which is far more complex, it needs a lot more detailed understanding. And at your age, maybe as of now, you would not be able to do that. Better to pick up a good mid cap scheme of a mutual fund, or a small cap scheme of a mutual fund, or a multi cap scheme of a mutual fund, and put some money every month. That is my suggestion. Mid and small cap investing largely through mutual funds. Large cap investing largely through direct or even mutual funds is okay. Okay. What are good companies? I mean, my idea of this page was to give you a sense that, out of 5,000 companies, guys, not more than 800 companies would be good. 4,200 companies would actually be junk. Imagine 4,200 companies out of 5,000 companies would be junk. It is only the 800 companies which is today listed in markets which are worth looking at. Worth looking at. I'm not saying all are worth investing. And that is where, the study of what is a good company, which company is fundamentally sound. These are few traits I have mentioned to highlight you what you mean by a fundamentally sound company. Typically, good company will be market leaders in the sector. They operate. They are the market leaders. As I mentioned, Maruti owns 47% market share of automobiles. Out of every 100 cars, 47 cars are sold of Maruti. Imagine. That's a huge market share. They're leaders. And they have built it every year. It was a company which has faced competition. There were new guys like Hyundai who have come in. There are new players. Everyone is coming in markets, right? India is a big economy of young individuals who are making money. They want to aspire to own cars. And Maruti has faced that competition, but still it maintains the market share. So that speaks about the quality of a company. Nestle, by the way, again, this is a MNC. It's not an Indian company, but it is listed in India. It has 80% market share of Maggi. Imagine. There's so many guys who tried. ITC tried with its noodles. Top Ramen is there. There are so many other noodle companies available, right? But Maggi is every nook and corner. Interestingly, I was in Mahabaleshwar 3 days back, and I was talking to one of my friends that here you don't have network. The network area of Mahabaleshwar, the mobile network was very, very bad. But every nook and corner there was Maggi which was sold. Every nook and corner, Maggi was sold. So we made a joke that you don't see network here, but you see Maggi. So imagine that is the kind of market share this company has gained, and it is surprising. It is fascinating that 80% market share in a country like India is owned by just one player, Nestle, and that is why the stock has done so well over the last few years. Bajaj Finance, I'm sure, is one company you guys are aware of. Again, they are market leaders in lending. So you buy a phone, you buy a TV, you buy a washing machine. You don't have to pay upfront. You go to Croma, you go to any other retail outlets. You get financing ability. You get the ability to finance. You have to just pay EMI for the next 6 months, and you own the phone or you own the refrigerator. That is done by Bajaj Finance. The lending is done by Bajaj. They're leaders, and it's not a very old company. It's 10-year-old company. So it was 2008-9 when they started this model of lending against all these consumer goods, your mobile phones, your TV, your fridges, and see today they are market leaders. They have gained market share from banks. They have not allowed any other financial company to have that market share what they have. So market leadership is very, very important part of being a fundamental sound company. The second point, again, I told you that these are the companies which have gained market share from competition. So HDFC Bank was a bank, I told you, right? In India, there are not less than 30 banks. You have SBI, ICICI, Axis, name it, right? So many banks competing against each other. But HDFC is one of the banks which has consistently gained market share. I was talking to Dr. Anita in the morning. It's not that SBI, which is looked or which is seen across every street, you see a branch of SBI or an ATM of SBI. SBI definitely is most widely spread in India. It has presence in rural, it has presence in urban India. But which is the bank which is doing the best? It is HDFC Bank. So something which is just seen is not the leader. You have to see how the company has been able to grow its market share, what is visible in the fundamentals of the company. HDFC Bank is growing much, much more than SBI Bank. And the stock price of HDFC Bank has also done very, very well. Asian Paints, the paints company, right? The one company which comes in your mind when you look at paint industry is Asian Paints. And these are the guys who have actually done phenomenally well. They have faced competition from Berger Paints, Nerolac, but these guys have stood firm, and every year they are gaining market share. Pidilite, you've heard about the brand called Fevicol, right? That's the brand, right? When you talk about Fevicol in adhesives, that's the only brand that comes in your mind. Imagine Pidilite is another company which has constantly gained market share. Titan, the watch company, the gold Titan, Tanishq, they are part of the same group. So Tanishq is the gold business of Titan, and otherwise Titan's main business is watches. Constantly gained market share from gold players, jewelry players, and even watches. So very important trait is they are gaining market shares from competition. A good company, a sound company gains market share from a competition. The return ratios, earnings, margins, which I spoke to you as a concept, are very sound. They're very superior. So they will be leaders, or their ratios will be much better than the competition. So today, HDFC Bank's return on capital is say 18% compared to ICICI Bank or SBI Bank, where the return on capital is not more than 12%. Imagine. So that kind of return ratios are what you look for. When you say stronger balance sheet, they have very less borrowings. They have grown through their own capital. They have not borrowed from market. So the debt levels are very small compared to equity. So strong balance sheets, these are very again important aspects. You look for a fundamental sound company. Who runs these businesses? Eventually it is human beings, right? It is the professionals who run this business. So management, when you call the company management, it is very important what quality they are of. They are clean. Are they clean? They have the best practices. They do not resort to frauds, because they are the ones who build businesses. They are the ones who are driving force. So which banks are you, which company invested into? It's very important. You look for the management. You look for their backgrounds. And there have been many cases, right? There have been many cases where even if a company is large cap, it is the management which has led to the debacle of the company. The companies have gone, they've lost the market share, they're nowhere seen. The classical example is Yes Bank, right? Yes Bank was a known bank in the past, a large bank, but the fraud was done by the management. They started lending to businesses which were questionable. They took bribes for lending money, and today Yes Bank is nowhere, right? So a lot of companies go through frauds, and it's the management which is doing frauds, right? So you have to be very careful. India, as I told you, out of 5,000 companies, only 800 companies probably would be worth looking. Rest 4,200 companies are not even worth looking, and because of the corporate governance, because the management is not capable. There are other companies which you might want to read about. PC Jewelers was another company in the gold jewelry business. It went through a complete fraud route. The company is nowhere. 1% Beverages is another company where they started competing with the likes of Mazas, and company showed profits, abnormal profits, but when the audit happened, it was clearly a case of fraud. So frauds are very rampant, and you need to be careful. And that is the reason fundamental investing is far more crucial. Knowing the businesses, understanding whether they are right numbers, and all that comes through years of practice and obviously professional courses which helps you to understand them deeper. Okay, so this is probably my last slide, guys. It is not a easy route, as I mentioned. It is a very in-depth work. Reading is imperative. Reading is essential in investing. Even today, I don't leave a single day where I'm not learning or not reading something. And the best way to read is, subscribe to magazines. There are business magazines called Business Today, Dalal Street, newspapers. I mean, honestly, guys, a very good source of information about companies, about concepts. Mint, I love it. I think Mint is one of the best, and even Financial Times. There are various financial blogs, and these are basically invested gurus or guys who have built their careers in finance and investing, and they have tried to disseminate that information to the audience. So you can go through CFA blogs. You can go through Vijay Malik. He's another professor. He writes pretty well about companies. There's a website called Safal Niveshak. Very good website. Again, talks about investing and companies. There are free research websites. If you are curious about understanding companies' ratios, these websites help you. Valuepicker.com, Screener.in. A lot of these memos, which are very important, I think they are the best way to learn from the mistakes of these known investment gurus. So Howard Marks is another very well-known investor. His company name is Oaktree. He writes every quarter. His memos are available in websites. If you type Oaktree memos, you'll get Harvard marks. Berkshire Hathaway, I'm sure you're aware of, that's owned by Warren Buffett. He also writes. Our own Samit Vartak, he's the CIO and founder of Sage One. He writes really well. His memos are very well appreciated. The memos are in our website. You should definitely go through the memos. You'll learn a lot about investing. And some of the books which you should definitely read in the course ahead. Damodaran on valuations, a very good book. Peter Lynch, a very well-known investor, his book on Wall of the Wall Street. Benjamin Graham, again, I think this is the one book we should start with, The Intelligent Investor. And lastly, I think the last book which I read was Psychology of Money, which is by Morgan Housel. It talks a lot about, not just investing through fundamentals. It also talks a lot about behavior part of it, because he believes that investing is not about just, identifying stock. It is about how you behave in falls, and, how you behave in terms of your patience and your conviction. That is also very, very important. So investing is knowing the fundamentals, but at the same time behaving in a rational way, right? So with this, I would like to end my presentation. This is my email ID, guys, sp@sage1investments.com. Please feel free to write if you have any queries. The website is sage1investments.com, where you'll see the memos. Would love you guys to go through that, in your leisure. And happy investing. I now open the floor for questions. Thank you.
Thank you, sir, for the informative session. So there are a few questions that we have lined up for you. So my first question to you is, we students are confused about mutual funds and stock market. Can you tell us some points of differences?
Certainly. So I did mention in the presentation, you need to invest in equities, right? So how do you invest in equities? You either do directly, which is buying and selling stocks on your own, or you do it through professional enterprise. So mutual funds are nothing but houses where you have professionals who have years of experience understanding markets, and you give them your money, which they invest through their funds. There are various schemes available in the market. I always, I have advised you guys that, being the novice and beginners, mutual fund ideally is the right way to invest in markets. But yes, you have ability and you have options of investing directly through brokers.
Okay, sir. So my next question to you is, it is said stock market investments are very risky. Karodpati to Rodpati journey in our student language. Is it true or a myth?
Well, I think markets definitely have a risk element, but how you invest is very, very important. If you adopt a speculation trading way, I would say definitely it could be a risky market. But if you do through a very disciplined approach and a very thoughtful approach, which I mentioned, be invested for long term, be patient, I think this is the best asset class. Ones who probably have taken the speculative way probably say that this is a risky market and you don't make money. But I have numerous examples of individuals who become billionaires or who become the wealthiest person in the world only by investing. Warren Buffett is a classic example, right? He's a celebrated investment professional, and he's in the top 3 in terms of rich club, and he's made all his money by investing and long-term investing.
Okay, sir. So my next question to you is, as a student, how do we start cautiously in stock markets? Which shares we should concentrate more on?
Okay, so there is no single answer. I think I covered in my presentations that if you have the ability and if you have the foresight of looking into sectors which will do well in the next 5 years, or if you think you have the ability to understand the companies well, which of the companies are there listed in that particular sector, you should take the route of directly investing. sectors which I believe will do or should do really well going forward, I think India is now slated really well to do manufacturing. India, which was largely a services-driven economy, is now focusing a lot on manufacturing. So what China did in the last 10 years, I think India could do in manufacturing. So manufacturing is a very wide term, right? Manufacturing could be electronic manufacturing to pharmaceutical manufacturing to chemical manufacturing. That should really do well. But having said that, I think it's a very lengthy topic to discuss. The best way to invest would be invest through mutual funds because they know the best which are the sectors which will do well. I would say that is the better way.
Okay, sir. So my last question to you is, what features should we look at when we go and open a demat account in bank?
Right. So it's important to choose the right platform. Typically, a bank is established banks like HDFC, ICICI. Their platforms are very, very good. When you open a demat account, you need to be aware of the hidden costs. Typically, a demat account will have an annual charge, and they also will have charges when you are buying a share and the share goes in the demat, and when the shares are going out of the demat. So that cost you should be comparing well. At the same time, the brokerages, what you end up paying up for buying and selling. Typically, that is something which you should look at. In today's parlance, these costs are very, very less. The way this industry is evolved, not much of the cost is involved in terms of buying and selling directly. In fact, when you buy mutual funds, it's all part of their overall fees expenses. So you would not be too much worried on if you're putting money through mutual funds. But yes, when you're buying and selling stocks and you're opening a demat and a trading account, these are the costs which should be very off. Go with the larger platforms. I would say that's very important because you have a lot of businesses which have become a fraud, eventually. So you must have heard about, last India Nivesh was a classical case where fraud happened of clients' stocks lying in the demat. So don't go with a boutique or a small-time broker. Ideally, choose a larger bank or larger institutions. Zerodha is another good probably area or a good firm to invest.
Okay, sir. Thank you, sir, for your prestigious time and guiding us. Now I would like to call Ms. Barze to propose the vote of thanks. Over to you, Ms. Barze.
Thank you, Ms. Varste. An investor without an investment objective is like a traveler without a destination. Thank you, Mr. Sharad Pachisiya, for teaching us the best of your knowledge. I would like to extend my vote of thanks towards the audience for their presence and cooperation. Before I close, a reminder for tomorrow's session. We have Mr. Abhijit Punde who will guide us about our next topic, that is, small steps towards the world of bonds and derivatives. So stay tuned and don't forget to subscribe our YouTube channel and like our page on Facebook and Instagram. Thank you.